Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit 1 of CAPE, and I'll be doing the entire series of past paper from 2013 right down to 2019. Amar, Mohan and are equal partners in a retail clothing business. They each contributed $240,000. After it was agreed that Lee should join the partnership with all three partners sharing profits equally. For the purpose of admitting the new partner, the goodwill in the business was valued at 180,000. Goodwill is not to be maintained in the accounts. Lee brought in cash of 160,000 into the business. Prepare the capital accounts of the partnership showing clearly adjusted balances after the admission of the new partner. Okay, now this here is the partnership account. I've done it already. I'll go through it with you bit by bit. Amar Mohan Lee partnership capital account. So, okay, this side here is the debit side, and this side here is the credit side. Um, the balance brought down 240,000 and 240,000 to Amar, E for Amar, and M for Mohan. L is for Lee. Lee was not in the partnership at the beginning, so he does not have any capital here to bring down. So only Amar and Mohan. Next, you are going to apportion the goodwill in the business up until the time Lee comes in. So it means that goodwill is only going to go to Amar and Mohan. They are alone going to share it. And it's 180,000, and they are equal partners, so they will get 90,000 each. Lee will not get any because he did not help in the creation of that goodwill because he was not in the partnership as yet. Next, Lee is going to come into the business and he's going to bring $160,000 in cash. So we put in the cash here into Lee account and the cash here into Lee account. Next, he is going to receive a portion of the goodwill. So we need to divide this goodwill now into three persons when we are removing it from the books. And three equal portions will give us 60,000 each. And that's this entry here. Okay, so this 60,000, 60,000, 60,000 will come out of the books to remove goodwill from the books. And after that, we can balance the account and we will get the balances here, the adjusted balances after the been admitted to the partnership. So when we balance the account, we notice that Amar will have 270,000 and Mohan 270 and Lee 100. Although he has brought in 160,000 into the business, he is his account is only showing 100 because 60,000 in goodwill has been removed from the business. The same applies to Mohan and the same applies to Amar. Their balances would be 60,000 short because goodwill has been removed from the books. Okay, coming up next, part B, the stay wrong. Part B, distinguish between corporations and cooperatives in terms of the following characteristics. 1. Transferability of ownership interest. 2. Voting rights. 3. Purpose. And 4. Legislation. Okay, first let us look at transferability of shares. Corporation the cooperative. Ownership interest is transferred by sale of shares on the stock exchange to anyone who holds shares in a corporation. And in a cooperative society, ownership interests can only be transferred by permission of the management rules and usually to family members only. Voting rights, corporation, cooperative society. In a corporation, voting rights are according to common or ordinary shareholding. And each ordinary shareholder is entitled to attend the meetings of the company, and every share held carries one vote. In a cooperative society, on the other hand, voting rights are according to memberships, with each member getting one vote. Shareholding is not considered as a right to vote. A corporation, the primary purpose of a corporation is to benefit its members or its shareholders. Usually, this means shareholder wealth maximization. That means you are setting out to maximize the wealth of the shareholder. You take the amount that he has invested in the corporation, and the management will look to maximize that wealth production from that. Cooperative, on the other hand, main purpose is also for the benefit of the members, but only by pooling of the resources of the members. Usually, the cooperative is organized around a common economic goal. Legislation. Corporation. In the English-speaking Caribbean, corporations are regulated by the Companies Act in the various countries. The cooperative societies are regulated by a separate Cooperative Society Act. Coming up next, the statement of comprehensive income. So stick around. Subscribe, like, comment. Okay, we are given an adjusted trial balance for Poindex Limited as of 31st May 2014. It's in a columnar form, so it does not tell us which side is debit side and which side is credit side, or even if it balances. But let's see what is required first, then we will know how to proceed. Prepare a statement of comprehensive income for Poindex Limited for the year ended 31st May 2014 and identify the figures to be included in current assets, current liabilities, which would appear in the statement of financial position as at 31st May 2014. So it does not require the entire balance sheet, just the current assets and the current liabilities. And it also does not ask us to conform to IAS or IFRS standards. Okay, so we can use any format we wish to. Poindex Limited depreciate all assets at a rate of 10% per annum using the reducing balance method. Depreciation is normally allocated 40% to distribution and 60% to administration. So we notice that the depreciation is already calculated 101,000, and we will have to allocate that 40% and 60%. And also we are seeing a loan here of 735,000, a 15% loan but there is no interest given on the loan. In fact, there are no financial expenses. So we will have to assume in this problem that the interest on the loan has not been paid yet. Okay, let's move on next to the working. Now we have the workings. We start first with the selling and distribution. The balance in the trial balance is 125,435, and we add the depreciation of 40% of it is 40,400. So the new figure for your profit and loss account will be 165,835. Then we have the administration brought forward, 234,195 from the trial balance. And we add the depreciation, 60%, at 60,600. And we also are going to write off the research costs, which we see in the trial balance there. And we get 310,465. Now, concerning the research cost, the normal position in that is either you capitalize it in your balance sheet and you are going to write it off on a regular basis over a number of years, or you can write off the entire thing in the year of occurrence. What I've chosen to do here is to write off the entire thing in the year of occurrence. Pointex Limited statement of comprehensive income for the year ended 31st of May 2014. We need three columns: sales, that's the cost of sales; inventory 1st of June; and the purchases. The purchases go in a new column so we can minus the returns outwards from it, and the discounts received. The net purchases is 387,300. That is this figure for purchases minus the returns and the discounts. And we plus the inventory from that, and we get the cost of sales. So it's a pretty simple affair, this income statement. 508,000. I will do it in two slides, so the other part coming after the profit and loss section follows immediately. Other income, 35,000. The total gross income, when we add the other income to the gross income, we will get 543,000. Okay, so the total gross income of 543,000. The operating expenses, selling and distribution, 165,835 from our workings. Administration, 310,465 from our workings again. And the total operating expenses is 476,300, giving us a net income before tax and interest of 66,700. Now, depending on how we interpret the loan, we will proceed from here. If we take the loan as the interest being accrued, then we will have to minus the interest here, and that is 110,250. So we end up with a net loss of 43,550, and you don't pay taxes on a loss, so you can't take 25% of this. But if we assume that the interest on the loan is not accrued, then what we have to do is charge the tax on the $66,700. Okay, so coming up next, the current assets and the current liabilities. Subscribe, like, comment. Look at the current assets. Inventory on the 31st of May, that's at the end of the year, 2014, 145,300. Then we have the accounts receivable, 405,000, giving us a total of 350,000. These and the accounts payable is 79,750, tax payable 7,500, and the interest payable 110,250, and giving us a total of 197,500 to be shown in the balance sheet as current liabilities. Now, if this video has been helpful to you, you would want to consider subscribing so you can make comments in the box below and you can get feedback from Mr. James. Subscribe, like, comment.